Our next speaker is Professor Chen. Is an associate professor of finance who came to us from the University of Chicago. His research focuses on asset pricing and its connections with corporate finance. This year, we received the Best Paper Award at the Red Rock Finance Conference for measuring dark matter in asset pricing models. He also won the Chinese Finance Association Best Paper Award for debt taxes and liquidity. We've been teaching the Futures and Options class along with John Cox. His topic today is credit risk and liquidity risk. 1 + 1 is greater than 2.
All right, it's a great honor to be talking about my research in front of this audience. As Eric mentioned, I'm going to talk about credit risk and its relation with liquidity risk. So in a way, this is kind of a narrow topic compared to some of the earlier talks you have heard. But I think towards perhaps the end, I will give you some macro perspective to think about bigger picture as well. So, is there clickers? This is. Okay, here we go. Okay, so to make sure everybody's on board, I'm going to start with a definition. What is a credit spread? I think anybody who has opened up a Wall Street Journal knows what a yield to maturity for a bond is. So I'm going to start from there. You think about the credit spread as people often measure is essentially a difference between the corporate bond yield or yield to maturity and a treasury yield of similar maturity. Okay. So, for example, if you look at the market yesterday, an AT&T bond that has a 10-year maturity has a yield to maturity of about 3.785%. The 10-year treasury is about 2.128. So if you take a difference between the two, that's about 1.66% of a credit spread, or as people often refer to in this field or in this market, 166 basis points of spread. So that's what we're talking about in terms of measuring the cost of a bond in terms of its credit risk exposure. But there's actually been a lot of attempt at trying to decompose or understand what actually determines this spread here. So for example, some of the obvious candidates are going to be credit risk related. For example, expected default losses, which essentially is your judgment about the probability of default, chances of default multiplied by the losses given a default event. That's expected loss, but on top of that, there's probably some premium people associate or demand for being exposed to these kind of chances of default. So that is what people refer to as a default risk premium. That turns out to be not the entire picture. People actually have found out that there's other components that also contribute to this credit spread here. For example, there are tax treatment differences between corporate bonds and treasury. Interest income on corporate bonds are taxed at state level, whereas treasury income is not. That turns out to account for some of the spread. And then treasury spread itself is actually kind of special, right? So in particular, for example, when we talk about flight to quality kind of events, treasury becomes a special security that actually is traded at a spread that's below even the so-called risk-free rate. And that probably accounts for some of that as well. But essentially, what turns out to be like a residual claimer is this mysterious term called the liquidity or liquidity component. In a way, I think I've heard other people mentioning this. People sort of reserve this as a term that basically claims for anything that we cannot explain satisfactorily using a theoretical or some kind of a structural framework. So that essentially is what we're after in my talk today, is to understand in the liquidity component, perhaps in a more structural way, and in particular in relation to the fundamental risk embedded in these kind of securities. All right, so as I mentioned already, we already have a lot of empirical evidence documenting the fact that the default doesn't count for everything. In particular, for example, one of these empirical studies by Longstaff et al. Have documented that for really high-rated bonds like AAA and AA, about half of the spreads are actually non-default related. And if you go down the tier, the proportion of default-related components becomes more important. For example, for BBB-rated bonds, you get about 70%. There's also a very interesting empirical evidence trying to document the relation between liquidity and cross-sectional characteristics of bonds. For example, related to ratings, related to maturity of the bonds, and so on and so forth. But I think it's I think I can safely speak on behalf of my colleagues at MIT. A principle of sort of research we do here and we value is we're not sort of satisfied with just documenting empirical facts, but we really want to strive for understanding something deeper on the fundamental. In particular, in this case, we're trying to understand sort of fundamentally what determines this mysterious residual term, liquidity, and in particular its relation with the fundamental risk in these securities. So it's very much in the spirit of what Bob did in the earlier work and the seminal work in the structural credit risk models. What this paper is trying to do is to actually put down some structure and in a relatively simple way, a coherent framework to think about what actually determines liquidity, in particular in the context of corporate bonds, and its relation with fundamental risk in the credit market. In doing that, we hope to show you some interesting. We hope to show you some. Hopefully, this is also a false alarm. We hope to show you some interesting connections between these two terms that are perhaps speaking to your intuition about how these markets behave, and perhaps give you some new insight about thinking about liquidity and default risk. Okay? All right, in particular, we're going to try to provide a new way of thinking about how to decompose the spreads. And I'm going to try to compare that kind of way of thinking to some of the more traditional way of thinking about default and liquidity. And I think it actually is helpful in terms of understanding the nature of the problem. In particular, when you ask why should you care about what we're talking about here, I think there are three potential perspectives you can take to think about why this is maybe a relevant question. For example, first of all, think about from the point of view of a investor, bond investor. Right? The natural question is, how do you price a corporate bond in the context of thinking about both liquidity and default risk? And in particular, some of the sophisticated institutional investors engage in this so-called negative basis trade, trying to explore the difference between the CDS, this is another credit instrument very much tied to the default risk, and the corporate bond spread difference. This was, for a while, thought of as a textbook arbitrage opportunity, which turns out to be not so much an arbitrage. But I think the kind of fundamental research we do, relatively fundamental research we do here, is actually going to shed some light on how you can think about these kind of trading opportunities or lack of it. The second perspective you can take is more from a firm perspective. So thinking about, for example, accounting for losses. So what I mean by that is when you see, for example, your credit-related instruments are losing value, at what point do you actually recognize it as a loss? Using some kind of accounting jargon, at what point do you recognize as a sort of a temporary versus a permanent impairment? And that is something that actually is a very heated debate. There's actually a very heated debate about this topic, and I think a lot of sort of theoretical guidance can be useful here. And then finally, as I mentioned, that's why I promised to actually try to elevate this question to a more macro level. I think we can actually use the kind of framework we're talking about here potentially to do cost-benefit analysis for certain liquidity provision programs. Debbie mentioned about measuring the costs of government programs. In a way, this is kind of thinking about the benefit side, and in particular thinking about the benefit not from a narrow point of view of improving market liquidity, but rather thinking about the fundamental effects that market liquidity improvement can have about the economy as well. So with that in mind, I'm going to actually try to explain the theoretical framework. So this is a little bit daunting given the time I have, but I'm going to try to do this in a sequence of diagrams. Hopefully, at least you get the basic idea behind the model. And for those of you who are interested, you're more than welcome to check out the paper itself. So how do we usually think about default risk? So just to borrow the notion that actually started with Bob's earlier work as well, is you can think of a firm more or less as a a box that's churning out cash flows, right? So it's like a cash flow generating machine, and the firm is issuing debt as part of the financing package. So on the one hand, you have a firm here that's generating cash flows. It's issuing debt to the public debt investors, and in the process, paying coupon to the debt investors. And this debt is finite maturity debt. So in doing so, you're going to have to repeatedly and periodically retire the debt and replace them with new debt. So in a way, you're refinancing the mature debt. So that's sort of what this box is trying to illustrate the idea behind this cycle of issuing new debt to replace existing debt and so on and so forth. Now, fundamentally, what determines default risk in this case is the cash flow risk in this firm. So in particular, if you have observed that there's a persistent or permanent drop in the profitability of the firm, those are probably the times when you start thinking maybe as an equity holder you should walk away from the firm and exercise the option to default. So in that sense, there's going to be some endogenous decisions made by the firm to decide at what point is the profitability so low that they actually want to walk away, and that's given by the so-called default boundary. Now, this is essentially the framework that we have spent a lot of time studying. And one thing that is obviously missing from this is this notion of liquidity. What is liquidity here? And that's essentially the focus of this, is to try to put something concrete on this liquidity side. So let me put one other element into this picture, which is the so-called quote-unquote liquidity shock. Okay, so what do we think about as a liquidity shock? For now, I'm going to try to use another mysterious term to replace this mysterious term of liquidity, which is so-called holding cost. Suppose this public investor who was originally holding this corporate bond got struck by so-called liquidity shock. As a result of that, the investor who is still stuck with this bond is going to incur the so-called holding cost for keep carrying this bond now. Okay? I haven't told you what that holding cost is, and that's another important question we have to try to address it somehow. If that is the case, then from the point of view of this investor who was struck by the liquidity shock, now his or her valuation of the bond obviously is going to be affected, because now holding the bond is actually more costly than before. There is actually a way out for this investor, which is to wait until the bond matures. So if the bond actually matures, then you're relieved of your duty of holding the bond, and you actually get the money back from the firm. However, what is missing from this picture, obviously, is a secondary market. If there is a liquid secondary market out there, this investor doesn't have to hold on to the bond until maturity. He or she can just easily sell the bond into the secondary market in exchange for the cash or liquidity she needs. So let's add that secondary market into the picture, finally, to complete the model. And in this case, what is kind of important characteristic of the corporate bond market, and in general any other market that doesn't have a liquid secondary market, like, for example, equity, is that there is typically these kind of transactions will be done through the over-the-counter market, and it's actually not so easy to find a natural buyer who is willing to pay the quote-unquote fair price for your security for reasons such as asymmetrical information or kind of a mechanical frictions in terms of search. And a way to sort of think about that is let there be some kind of a random delay in the process of finding the good buyer, and for which you have to then endure this duration of incurring this holding cost. Okay? So as I mentioned, really what we've done so far really is replacing liquidity with this notion of holding cost. I still haven't told you what exactly is this notion of holding cost, which is the gist of the liquidity shock. So to think about the holding costs, I think you want to think about in particular, what is the liquidity shock doing to this investor in the first place? We think of this liquidity shock, for lack of better words, is basically all of a sudden you have a significant need for cash. What could be examples of that? It could be that, for example, a redemption request for these asset managers. It could also be that, for example, insurance companies who had the mandate to hold investment-grade bonds, but all of a sudden, because of downgrade, they have to unload the bonds. The bonds that are downgraded to below investment grades. So to put, again, the structure on the table, this is key for us here, we have to think about exactly what this does to the investor. So here's how we think about it. It's probably not necessarily the only way, but it's one way propose to think about it structurally. We think about two alternative ways to raise financing if you actually need a lot of cash. One way is to think about borrow in an uncollateralized manner if this is available. And for that, obviously, you have to pay some kind of interest cost for that. So if R it can be thought of as the risk-free rate, then this chi here is going to be this additional spread or cost you have to incur for borrower in a uncollateralized manner. And potentially this could be very high if uncollateralized lending is scarce. But remember, for these investors, they actually have this bond in their portfolio. So they could actually use the bond potentially as an asset to do collateralized borrowing. So, to the extent that it's possible to use the bond as the collateral asset as collateral to borrow against, then you can actually save some of the cost of financing. How much can you save? Well, that depends on another important thing, which is the haircut you face on the bond itself. If there's a large haircut on the bond, that means that for, let's say, $100 worth of market value of the bond, you can only borrow a very small fraction of that through collateralized lending. If the haircut is very low, then you can borrow up to close to $100, for example. So this haircut obviously will depend on the riskiness of the bond itself. Okay, so now we can actually finally talk about what is this mysterious holding cost. Essentially, this holding cost is an opportunity cost of holding this bond. Think about the marginal benefit of the bond as a collateral. In that case, without going too much into detail of the calculation here, you can think about intuitively as the benefit coming from the fact that you can use a fraction of the bond as collateral to borrow against. The fraction is determined by the haircut you're facing. So the higher the haircut, the smaller the fraction, which means that the smaller the benefit is. Alternatively, if you could actually sell the bond, for example, at a secondary market price of B, then you immediately get that part or the cash, and then that amount of saving is going to be proportional to the additional interest rate spread you're paying on uncollateralized lending. So the difference between the two essentially gives you a more or less concrete notion of what this holding cost actually is for the liquidity-struck investor. So now we can actually talk about, back into this picture here, talk about what I mean by interaction between liquidity and default risk. On the one hand, you start thinking about how the fundamental risk of the firm actually affects liquidity of these bonds. It comes through two channels. One is that the default risk, the default risk here reflected in the bonds itself will directly affect the liquidity of the bonds because it affects the recovery value of the bond in the event of default. But secondly, perhaps a more interesting channel is through this holding cost channel. As I mentioned already, the holding cost effectively is determined by the haircut you are facing when you're posing a risky asset as a collateral. And obviously, the more credit risky the bond is, the higher the haircut endogenous has to be adjusted. Will have to reflect that kind of level of risk. And as a result of that, the effective holding cost would have to rise accordingly. So that's sort of the direction going from default risk to liquidity. And the more default risky the bond is, the higher the liquidity friction you can be facing as a secondary bond investor. But the channel goes the other way as well. So remember I mentioned that the firm is fundamentally determining when to default. And the firm is facing a non-trivial issue of rolling over the debt, right? Because we have this finite maturity debt here that is sort of churning over through the cycle. Imagine a sort of a quote-unquote liquidity event that pops up just at the time when the firm has to roll over a big chunk of the debt. Now you actually, because of this kind of liquidity event, the secondary market pricing of the new debt you issue is going to be on unfavorable terms. And as a result of that, you're going to incur this additional rollover cost simply due to market liquidity. And as a result of that, fundamentally, the firm's decision on default will be different. And it's going to be caused by this kind of a liquidity friction in the secondary market, in particular in relation to the difficulty in roll over the existing debt or mature debt. So now we have essentially the complete picture. On the one hand, I mentioned to you that the default risk affects liquidity, but on the other hand, through the rollover risk channel, liquidity also feeds back into the firm. And that is a very different way of thinking about these two components than simply thinking about one as the determinant determined by fundamental, the other one is sort of the residual claimer for whatever we cannot explain by fundamentals. So now we can actually do some kind of calibration to see how the model actually does, right? Because now I have sort of explained to you more or less the intuition behind the model. A benefit of doing this in a structural way and in a rigorous way is to put some numbers on the table. Now, of course, there are caveats you can point out about the potential misspecification of the structural model here, which I'm very sympathetic to. But at least this, I think, is one way forward to think about these kind of loose intuition in a more formal way. And in particular, some of the exercises we can do, for example, counterfactual analysis we can do are potentially helpful as well. So without going into too much detail into how the calibration is done, which is kind of boring, the one interesting thing and important thing to highlight is that this kind of a structural model, even though it's sort of built at a very micro level, can actually be aggregated into sort of a quote-unquote aggregate moments. For example, things like thinking about aggregate default rates across firms, aggregate credit spreads across different rating categories, as well as the kind of a bid-ask spreads or reserve. And those kind of moments can actually help us discipline how to calibrate a model in a proper way. In other words, before you start looking at additional implication from a model, at least you know that you're in the ballpark in terms of the quantitative implications. So that's essentially what we did there. And let me skip forward here. So in a way, so this is basically showing you how the model does in fitting some of the basic stylized facts in the market. This is basically showing you that the model does a more or less decent job in matching the average level of default risk across several broad rating categories. The first line is the data, the second line is the model. And then if you look at the implication of the model on the average credit spreads, again, the picture seems to be that the big picture seems to be that the model does a decent job in terms of matching both the cross-section of the spread as well as a time series aspect. So here we sort of broadly define good times and bad times as correspondence to business cycle expansions and recessions. And you can look at how the model does in terms of matching the average level of credit spreads in certain rating categories compared to the data. So I think knowing that there are a lot of targets we're trying to hit here and a limited degree of freedom, I think this is basically telling you that the model, at least on the level and the cross-section of the time series, is doing a decent job in matching the level of default risk reserve. The next thing you can look at actually is kind of a new implication from this particular type of structural model is actually the implications on the liquidity measures directly. So for example, we can now talk about the model generated the bid-ask spreads in relation to the data. Again, the message seems to be that it does a pretty good job in matching the cross-section of the bid-ask spreads. And also you can think about, because the one thing is very important to us is to link this liquidity friction to the haircut, and we can actually compare the model implied haircut to what we see in the data. And then naturally, sort of in conformity with our intuition, it is indeed the case that junk-rated bonds will have a higher haircut compared to high-rated bonds. Okay, so that aside, now we can actually do something more interesting, which is to look deeper into the mechanism of the models and think about what pieces is driving what. Right? So for example, one comparative static that's natural to do is to think about a hypothetical environment where there's perfect liquidity. One way to do that is we have the luxury of the model, so we can easily shut down some of the liquidity friction in the model. For example, this holding cost of investors that hit by liquidity shock have to face. Once you do that, you can see that the model actually changes, implication of the model changes drastically. For example, both the level of default risk and the credit spreads drop significantly once you shut down the holding cost. What that is telling us is that fundamentally there is an important channel going from liquidity to fundamental default risk. So that is the sort of feedback channel from liquidity to default, as I mentioned before. And this sort of calibration exercise tells you in terms of magnitude how important this is. Next, you can also think about how important is our way of thinking about the cross-sectional pattern of collateral financing and the liquidity or holding cost, how important that channel is. So you can, for example, shut down this channel about tying the whole haircut that the investors face with the riskiness of the bond. Right? So as a result of that, you get a constant holding cost in the cross-section. And you see that that's going to really affect the ability of the model to generate some of the cross-sectional patterns of credit spreads as well as liquidity measures. Okay, so finally, one way to use this kind of a structural framework is actually now thinking about decomposition of default and liquidity components in a more meaningful way. Let me sort of review what the traditional view is. It's very much of an additive view about thinking about default and liquidity. You basically try to find some kind of benchmark to measure what is default risk and then attribute the residual part to liquidity components. So one thing that people have done in this literature is try to find some kind of instrument, financial instrument, for example, a CDS contract that has very much the same fundamental risk exposure in terms of the credit risk, but the secondary market for that kind of instruments have better liquidity than the corporate bonds. So the hope is that you can then use those kind of instruments to, in a way, as a control group to capture what is the fundamental default risk in there, and then you can attribute a residual part to the default risk, or to the liquidity risk. That obviously is not really what this model, our model, is going to imply as the right thing to do. We think of this as really a much more involved decomposition because we really need to capture and think hard about the interaction terms. You can think about a hypothetical environment where we shut down all the liquidity frictions and get how firms behave in those kind of environment. That is what we refer to as quote-unquote pure default risk, because this part of default risk actually is driven by the fundamental cash flow risk the firm faces. The second part is the so-called liquidity-driven default risk. And that part of default risk is because firms' optimal decisions, in particular decisions relating to default, is affected by the secondary market liquidity. And that component has to be highlighted as well. And then on the liquidity part, there is the so-called pure liquidity component we can calculate, again, hypothetically, by thinking about a bond that doesn't, for example, a bond issued by the firm that has no default risk whatsoever. Or think about this as a bond issued by a government-backed agency. In this case, obviously, there's no feedback effect from the default part to the liquidity part, and what you capture is simply the secondary market trading frictions that the investors face. And that is what we call as the pure liquidity component. And then finally, you get this notion of default-driven liquidity part, and that has to do with the fact that fundamentally this asset is risky, in particular in this context, it's credit risky, and that's driving the secondary market liquidity friction to be even more severe. So we can actually use our structure model to do this four-way decomposition, and we think this is perhaps a better way to understand actually how these different components interact. Well, this is conceptually how it works. We can actually use the model and the data to try to implement this. So this is a sort of an average picture to show you how, according to our calibration, is one particular calibration, how important these relevant components are. So for example, you're looking at the two gray bars, the liquidity-driven default and default-driven liquidity parts, as sort of the more innovative elements we're highlighting here. They seem to have different level of importance depending on the rating you're looking at. For example, for a very high superior rating category, most of the spreads are actually driven by liquidity and so purely liquidity components play a very important role there. Whereas if you go down the rating category, then these interaction terms, these kind of feedback effects are starting to show up in a more pronounced manner. This is what happens in the good times. You can also do the same analysis in the bad times. What is interesting is that because the secondary market conditions also change with the business cycle, there's actually an element there to be played. In fact, in the paper, we go into more detail to think about this kind of so-called liquidity default spiral in correspondence with the business cycle risk. And then finally, you can look at how the changes in the spreads you observe, according to our model, can be attributed to these different components as well. And there, the message is that these changes actually are, this kind of interaction terms play an even bigger role in explaining the change in the spreads over the business cycle, according to our model. All right, now, so this is the same decomposition in the time series. And what is interesting is now you can sort of compare the pure default component with the interaction term, as well as the pure liquidity component with the interaction terms. And again, see how the relative importance of the two things change depending on the market conditions, just to illustrate what potential things you can do with this kind of decomposition. So finally, there is actually one exercise we do to try to address a more sort of higher level question, which is use this framework to potentially get a better handle of what are the benefits of a liquidity provision program. And we essentially think about what is a liquidity provision program. In this model is essentially a way for the government to try to remove some of the heightened liquidity frictions in the market as the market goes from a good state to a bad state. So essentially, we have the luxury of just simply changing the parameters in our model, in particular in the bad state, to make the level of liquidity friction investors face, bring them back down to the level in the normal times. And now we can ask the question, how big is actually that effect of these kind of changes? Remember, the starting point is simply a change in the secondary market trading environment, but we can now think about both the direct effect, which is what's going to be captured by so-called pure liquidity component, as well as the indirect effect, which comes from the feedback effect from the liquidity to fundamental risk. So this diagram here basically highlights, sort of illustrate that idea. You think about a liquidity injection here, which is reducing the kind of frictions. For example, the cost of uncollateralized borrowing, or the ease with which you can find a trading partner to sell your bond to. Think about like the asset buyback program, for example. In that case, one direct effect is that the valuation in the secondary market is going to be benefiting from this kind of a liquidity provision. So now you can see that the value of the debt starts increasing, but that's going to feed back into the fundamental default risk of the firm, because now the cost of refinancing is going to be helped or reduced, and that lowers the fundamental default risk in the firm, which again is going to feed back into the valuation in the secondary market and so on and so forth. Now, again, in the structural model, now we can think about how big is this effect, right? So this sounds like theoretically kind of appealing, but really how much is the quantitative effect here? So one way we can address that issue is, as I mentioned, simply changing the parameters in the bad state about the liquidity friction to make them more or less look like in the good state. One caveat for those of you who are sort of already probably aware of this is that we are doing this very much in the partial equilibrium framework. We haven't even talked about how this kind of a government liquidity provision program can potentially affect the fundamental directly. This is very much just highlighting one channel, which is the secondary market liquidity. So with that in mind, this table essentially try to show you some of the magnitude we found in our exercise. The first two columns here are highlighting what would be the spreads, or if you want to think about it this way, the cost of borrowing through the corporate bond market for different ratings without the provision of the liquidity. And the second column here shows you the lower spreads as a result of this kind of a liquidity provision. And you can see that across different rating categories, the amount of saving is different. But much more interesting to this exercise is now we can actually break down into how these different components contribute to the saving in or lower credit spreads. And what's to be highlighted here is that, for example, in high rating categories, the pure liquidity component still plays a major role and counts for something like 50 or 60% of the total saving in borrowing cost or lower spreads. But once you go down the tiers, that becomes actually a much less important piece. And these interaction terms, for example, start to play a bigger role. Why is that kind of a message interesting? Because now you think about a quote-unquote naive way of measuring the benefits of the liquidity provision. For that, we probably focus mostly on the direct effect, right? So the secondary market becomes more liquid, the valuation becomes higher. That's the direct channel we're seeing in measuring the benefit. But this kind of exercise seems to show that the indirect channel, depending on the rating category you're looking at, can actually play a first-order role. And it's very much important to factor those in. And to do that, you really need some kind of structural framework to be able to say something concrete about the effects. Okay, so let me actually conclude. So what I'm trying to sort of talk about here is essentially an attempt to think in a more rigorous way what is the notion of liquidity, and in particular what is the what are the potential interactions between the fundamental risk, in this case the default risk, can have with liquidity risk. And we found that actually putting some kind of structure on the table can really help us understanding these kind of interactions better. And through calibration exercise, we found actually we can also say something about the magnitude, which is kind of interesting. We have tried to move towards a micro foundation for this mysterious holding cost or liquidity frictions in the market. I think in the spirit of how Bob wrote down the structural model for default risk, is very much a similar way that we are trying to put down some structure to think about a tractable structural model to think about how key elements in the financial market we can observe can help us understand and potentially even predict how the default and liquidity frictions actually play out in this market. And then finally, the kind of counterfactual analysis, in particular about thinking about the liquidity provision program, for example, can help us understand better at least the benefit side of these kind of policies. So with that, I'll be happy to take any questions you guys have. Okay, yes.
Thanks, Wee. Good presentation. What do you want to do next with this? Try it with different frictions, or what are your plans for the next evolution of this?
Sure. Just for the sake of time, I'm going to be brief about this. So one thing that we're trying to do is along these lines to push further this sort of so-called micro foundation for holding costs or liquidity frictions. So in this literature about search frictions, people sort of very much left this holding cost as a black box without saying too much about what actually constitutes a holding cost. So we think this is actually a interesting and promising channel, because this allows you to think about both in the in the cross section and in time series, how would these kind of liquidity frictions change, and that's hopefully eventually leading us to open up the black box of what constitutes liquidity friction. So that's one thing we're trying to do, and we're trying to collect some kind of repo market data to do this kind of test the prediction of this kind of model in a more concrete manner. So here is really just a calibration exercise. Another channel we're trying to push is to think about this more broadly, because this is so far is only about the corporate bond market, but this intuition we have about collateralized lending as the source of holding costs applies to really any risky asset trades over the counter. So we're trying to broaden up that kind of perspective as well.
Why don't we take one more?
One more? Okay, sure.
Have you applied this to the European debt markets, given what's been priced over there? And if you haven't, just curious what your takeaways would be, given where those asset prices have been trading in relation to, say, treasuries or even negative yields in Germany, and et cetera. Just curious your reaction. Okay,
so the short answer is no. We haven't tried applied there, because for one thing, in a way, we're trying to get better data on measuring, as I mentioned earlier, about what are the contributors for the default risk or liquidity risk. So in particular, the haircut information is very important for us. The kind of delays in finding a trading partner when you actually try to sell is also very important. And for that, actually, there are some good European data for this. So for example, we're talking to the Swiss National Bank about getting their repo market data. I think that's potentially the direction we are moving to, but we haven't done that yet.
Okay. Thank you, Wee.
Sure. Thanks.